where investment funds can explore Bitcoin on their balance sheets, risk-free, fear-free, worry-free. I'm your host, Dom Bay, and I'm a firefighter on a mission to bring Bitcoin to unions, pension funds, and workers everywhere. What exactly is this gauntlet? My co-host Rapha Zigury created a groundbreaking tool to input Bitcoin into any investment portfolio and then model the impact. Of course, if we're going to run a gauntlet, we need some backup. So we brought in the legendary Foss and Joe Carlasare. At the end of each episode, which you will hang around for, we jump in the hot seat and select a Bitcoin allocation for our fund in focus as if we called the shots ourselves. So get your mouthpiece in, mount up, and let's run the gauntlet. I see we got some familiar faces already in sight. Let's start by bringing up the co-host, Rapha, aka Alpha Zeta, the creator of the tool, the man with the plan. What up, Rapha?
What's going on, guys? Dom, thanks so much for setting this up, man. I think this is a great setup. Very excited to be here. I think we couldn't be in better company than we have today. This is going to be awesome. And I think, it's going to be very good to get some of the data, some of the numbers now into real life, right? What we're going to be looking to do are things that impact the lives of several people. So couldn't be better to do it this way.
Absolutely, all made possible by your creation. Of course, you had some help and inspiration. Foss, Joe Carlasare, thanks for joining us. Greg, you just got up from Boston, right? Fresh off the road. How are you doing?
Hi, guys. Hi, Joe. Rapha. Yeah, you know what? I was down for a great festival, Freedom Festival in Boston. Very, very, very well organized. It's going to be I'd say it's the foundation for a future Boston Freedom Festivals, and really happy that I was able to participate. So thanks for having me, Dom. I look forward to a very exciting and thought-provoking discussion with you guys. It's a pleasure to be here.
Absolutely. And Joe, we're lucky to get you outside of the courtroom. How are you doing?
I'm doing great. Just coming off of an intense prep for an arbitration that I was working on for a few weeks, which is done. So it's an absolute pleasure to be here with Dom, Alpha Zeta, and as you put it, the legendary Greg Foss. This is going to be so much fun. I cannot wait to talk about this because this really is the future for Bitcoin. I think bigger players understanding the unique attributes of this asset and how it can just radically improve the performance of your portfolio. So this is going to be great. Thank you so much for putting this together.
Dude, we're pumped to have you. Before we intro our guest, Greg Foss he may know our guest a little bit from here and there, up in the attic, up in America's attic in Canada. Elliot Johnson, a lot of experience in finance. Started, his own ETF and Evolve ETF, and founded and is a principal officer. Greg, you know him well. I got the chance to talk to him, and this guy is a rock star. I was blown away in the conversation with him and his outlook and knowledge on Bitcoin and finance. Give us a little bit of just about him and your experience working with him, because this guy's incredible.
Sure. Yeah. Well, thanks for the kind words for America's Attic, Canada. I met Elliot just after the great financial crisis. I was at a hedge fund that he was the chief operating officer. The man is a incredible visionary in terms of how to set systems up to monitor risk, to settle trades. I mean, I famously would put a trade on the books, and if we hadn't traded with that counterparty, but we had onboarded them, they'd say, how do you want to settle it? And I would say stuff like, well, I don't worry about that stuff. Elliot can settle anything. And so Elliot Johnson was the COO at a fund that was in which I was a partner. He was a partner. And this is significant. The founder of the fund was the chief risk officer of TD Securities. And that was a sell side institution. And he decided, that's Jason Marks, decided he was going to come to the hedge fund community, and I was his credit trader. And it was just a very exciting time to be around. Obviously, that was the great financial crisis, and a lot of things were very precarious. But Elliot has got a lot of experience. I hope we have time to talk about his visions as what he thinks the BlackRock ETF chances of success are. He'll tell you some of the, if you're interested, some of the specifics of the prospectus, the BlackRock ETF prospectus, which I know Joe knows. But one thing that I was interested to understand is that BlackRock is using the same pricing index that Elliott's Evolve Bitcoin ETF uses. They have a pretty interesting way of hedging out some of the basis risk, and basis risk is basically the difference between Bitcoin and the closing price on a given day of the pricing index. So Elliot just has a lot of experience, guys, and I'm really happy that you guys have found value offline, and hopefully we can bring that value online to people in North America. The reason I say that, perhaps you guys didn't know this, but the first ETF ever launched was in Canada. So we may lead the USA in hockey, not for long because the USA hockey programs are coming up quick, but I'll also say that we did lead in ETFs, and we do have spot-based Bitcoin ETFs. My hope is that that translates into United States opportunities as well. So looking forward to talking. Elliot is a wise man, and I'll try and keep my comments to a minimum because you definitely want to hear from him.
Absolutely. We're lucky to have him. We're going to get a chance to talk about Evolve. We'll break down an ETF for listeners that maybe aren't exactly familiar on ETFs and how they work. And of course, us here, our fund in spotlight, which Elliot has experience with, is the Ontario Teachers Pension Fund. That's over 330,000 members. These are teachers. These are hardworking, great folks that have their money in a retirement fund that are depending on that money when they retire to live out the rest of their life and enjoy their life. And so that fund is going to be in our hands on the show, and we have the opportunity to pick Elliot's brain, get some ideas on which direction we may go to make a hypothetical allocation in Bitcoin. So let's bring Elliot in and get him here. Elliot Johnson, the man, what is up? How are you doing? And thanks so much for joining us today.
Hey guys, thanks so much for having me. Really appreciate joining your show. It's good to see you, Greg. Your intro was too kind. And if I could return the favor just a little bit and say a few words about Greg. Obviously, he's well known to all of you in the Bitcoin community. But Greg and I met a long time ago when he was running high yield credit for the hedge fund business that we were a part of. And I can say two things about Greg. The first is I've always made money when I've co-invested with Greg. He is an excellent money manager. And the second and maybe more important point is Greg is one of the most thoroughly honest and straightforward people you'll ever work with. And that is a really refreshing thing when you are looking to work with somebody, because it promotes trust and it promotes a really great working experience. So I feel very lucky that Greg and I were partners in that business. And I feel lucky in the same way when I think about the work we're doing as it relates to the Bitcoin community. And Dom, you and I had a chance to reflect on some of this when we chatted before the show, but maybe just as an opening comment, I really feel like the Bitcoin community is a group of like-minded people looking to use Bitcoin to improve lives around the world. And I think it's inclusive. It's for everybody. We're proud at Evolve to be doing a small piece of contribution to that community by providing an access point for folks who want to own Bitcoin through their brokerage accounts. But honestly, my hat's off to everybody involved in Bitcoin. It's just so great to see this community come together. So many talented people from all walks of life. And anyway, needless to say, I'm grateful to be invited to your show, and thanks very much for having me.
Thank you, Elliot. Hey, it's with no sense of irony, right, that we have the Teachers Pension Fund as our first fund in highlight, because like you say, Elliot, the Bitcoin community at its core are teachers. I mean, Joe is a teacher in the legal space. Rapha's a teacher with his tools and research. Greg Foss is a teacher. Everyone's a teacher trying, and they're fueled by altruism and wanting to see people do well. and that's amazing. And that's how we keep meeting each other. So absolutely. Tell us about your founding and your role in Evolve ETFs. It's a very amazing fund with all kinds of options. There's a few bucks in there, as Greg Foss says. There might you have a couple bucks under management, right? I think well over 4 billion. I saw 6 billion on the website. Tell us about that and kind of how it led to the Spot Bitcoin ETF in 2021 that you guys filed.
Yeah, so we started the business in 2017, really with the thesis that there was a lot of room for innovation in the ETF market. The ETF, and we can get into more mechanical details if you like, but essentially an ETF is a way to package up almost any investment that you might want to put into a fund and then sell it through the stock exchange so it becomes accessible to everybody who can trade stocks. And that is an amazing package. And we saw in Canada, and we've seen it in the US, that ETFs are growing faster than any other asset category. And it's principally because of that flexibility. So back in 2017, we put together a group of us who had worked together in the past, and several of Greg's former colleagues also are part of the Evolve team today as well. And we started to build out an ETF business. And so this is a employee-owned business in Canada. We just went through $6.3 billion in assets under management in just under 5.5 years. So it makes us one of the fastest growing fund companies up here in Canada over that period of time. And what we've really been focused on is trying to build products that are going to be helpful for investors to invest in where the world is going in the future. And so that's why our name is Evolve. We really built our brand name off disruptive technology investing. We were the first in the world to, for example, build a fund that invests in the future of the automobile. We have other disruptive tech products. And one of our disruptive themes that we have been trying to bring to market since the beginning was Bitcoin. And we actually were the first company in Canada to file for a Bitcoin ETF back in 2017 when there were futures listed on the CBOE. But unfortunately, we weren't able to get regulatory approval back then. And so it took 4 years until we managed to get a Spot Bitcoin ETF launched in February of 2021. And the world has come a long way since then. But I think our original thesis has been proven out. And that thesis is that ETFs do play a role in providing access for investors to gain investment exposure to things that they might not want to buy directly themselves for whatever reason. Maybe they're working with an advisor on their financial plan and therefore they need it to be in the same account as their other investments. Or maybe they're in a registered account and their registered account can't hold some of these things. And Bitcoin is not the first asset to be put into an ETF for that benefit. Gold, famously in the GLD ETF, is a way for investors to get access to gold without having to buy gold bars, and find a safe and put them away. So we were able to get there with physical Bitcoin. We've got there with a bunch of other strategies. We now have 27 ETFs across a wide range of different asset classes. But decentralized digital finance probably was the biggest challenge, and Bitcoin itself was the biggest challenge in terms of the structuring of an ETF, because we really had to marry the exchange traded fund vehicle that has a 2-day settlement period from buying the ETF to selling the ETF. We had to find a way to put that model on top of a blockchain where there is no distinction between trade date and settle date. Everything is instantaneous, everything is transparent, and everything is, it doesn't have the same properties as other assets. You don't technically need a custodian to own Bitcoin. You can have self-custody. All of those features, we had to find a way to mechanically put those inside an ETF format. We were able to get there, and we're very proud of what we built. And as Greg alluded to earlier, the operating model that we put together for EBIT, which is our ETF in Canada, EBIT is the ticker, is the model that's being used by BlackRock for their ETF filing. And little known fact, but maybe news to some folks who are listening today, if you want the experience of owning what BlackRock is intending to bring to market, EBIT is available in US dollars today. And so if you can trade in Canada an ETF or a stock, you can buy EBIT.U. And it's the same thing that they're trying to build down in the US. So we've got it, we've got the experience, and that I think is helpful for folks trying to figure out how these products are going to actually behave when they come to market in the US, because you can look to Canada and see how physical Bitcoin ETF works, and it does trade extremely well. In fact, spreads are narrower than buying physical Bitcoin on a lot of exchanges out there. The liquidity is there, the market making support is there. It's a fully regulated product, all of those things. And so we brought that to market in a way that we think is useful to the consumer, and it's been a big part of our business in terms of getting us where we are today. Sorry, I was rambling on a little bit there from your intro question, but
No.
hopefully that's helpful.
Hey, Dom, can I jump in for a second?
Absolutely.
Elliot, pleasure to meet you. Joe Carlasare. I'm a commercial litigator at Amundsen Davis. I had a question about that. That was burning at the top of my mind. What have you seen in the way of flows from U.S. individuals, U.S. entities for EBIT? Has there been a lot of interest, folks trying to figure that out, or is it just too much of a barrier still because it's only listed on the Toronto Stock Exchange?
No, it's a great question, Joe. We have seen a lot of northbound flow, we think. Now, first of all, with ETFs, we don't actually know who the end user is because they trade on the exchange. But if we look inside the clearinghouse, in Canada, it's called CDS. It's the equivalent of your DTCC in the US. We see a lot of US dealers with a clearing point in Canada that own EBIT. So, for example, JP Morgan Canada, that doesn't have a retail business in Canada, we'll see that they own EBIT. So that's a sign to us that there's northbound flow. There are a few other things as well. Our lead market maker for the fund is actually Virtue, which is a US market making firm. And the reason we work with them is because when we launched the fund, frankly, we struggled to find a Canadian dealer that was willing to work with us on the fund. Although Canadian dealers have since become good participants and they're a very good part of the ecosystem up here for Bitcoin ETFs. But those things combined with the participation of the big liquidity providers, these are the folks who trade both spot and futures Bitcoin that are fairly well known in the ecosystem, lead us to believe that there's significant interest in our ETF in Canada from the US and overseas, also from Europe as well. So this product put Evolve on the map internationally. Prior to launching EBIT, we really didn't have many conversations outside of Canada with anybody. And since then, we now have a much wider network of relationships in the US and in Europe and in Asia as a result of people who've looked at this product and have found ways to use it for whatever their portfolio needs are in wherever they happen to be domiciled.
Hey, Elliot, I have a question here. Rapha Zigury, Swan CIO. So the number one question we've been getting from our clients regarding the BlackRock ETF is regarding the redemption and creation of shares, right? So according, I think, to the BlackRock filing, you need to be like I forgot the term, or maybe like an eligible broker dealer or something like that. How does that compare to Canada? Like in Canada, can investors actually get a delivery of Bitcoin at the end? Can they contribute Bitcoin to ETF creation? How does it work?
Yeah, so I don't believe the BlackRock filing has currently got any kind of language in there for the facility of taking self-custody of the Bitcoin that's inside the fund. We don't have the ability in Canada to directly deliver Bitcoin to investors if they wish to receive it. We can face large counterparties at our custody at Coinbase or at Gemini in the US, where we can face them cash versus Bitcoin, but you do need to have a round trip on the cash component of whatever that settlement would look like. So I think if you're buying a physical Bitcoin ETF with the intention of eventually taking self-custody, it's probably not going to be the best vehicle for that. You're going to be much better off going to other places like Swan Bitcoin and buying Bitcoin from someone else. The purpose of the product really is to allow you to hold Bitcoin in accounts where you are able to hold stocks, bonds, and ETFs, but where you can't hold physical Bitcoin today. And so that's more the purpose of it. But I'm also happy if you'd like to go into the creation and redemption mechanism, because I think it's very important. I have seen people talking about the BlackRock filing and not being confident in the way in whether it will in fact truly hold Bitcoin and track the price of Bitcoin and how the creation and redemption mechanism would work. And in fact, it's going to be 100% Bitcoin all the time, regardless of inflows or outflows, because of the way in which they've structured it. So I'm also happy to talk about that if people are interested in, proving out the point that operationally this is the same thing as holding physical Bitcoin. It just happens to be in a fund in your brokerage account rather than, in a hardware wallet that you happen to have instead.
Yeah, I'd love to fire some kind of like in a Mythbuster style, right? We've all heard so much talked about BlackRock, about what they're going to do, what their intentions are, and just fire some of those at you rapid fire to kind of get a good idea from someone who has a spot, Bitcoin ETF approved of some like, hey, what is like not even a consideration, et cetera. So like fire away. I have a bunch, but if you guys want to start with some as far as misunderstandings or things to clarify mechanisms, send it.
I'll start if you wouldn't mind, just to add something that Elliot mentioned, but was perhaps lost in translation. Not your keys, not your coins. 100% true. But let's understand that there's tax advantaged accounts in Canada in which the government essentially gives you a 50% tax rebate if you own Bitcoin in Canada, called your RRSP, which is a registered retirement savings plan. I'm a huge fan of cold storage. I own Bitcoin in cold storage, but I also own Canadian ETFs because I view it as in my tax advantage account, I can get $1.50's worth of Bitcoin for $1 investment equivalent. Okay. And that's important. And, you have to balance the risks and returns. I'm proud that Elliot is one of the multiple ETF providers in Canada. I believe his pricing mechanism is one of the most ingenious of the products out there. But talking bigger picture, it is important to understand that a lot of people, particularly my age, love Bitcoin when it has a QSIP attached. And that's lost on a lot of people. For those out there that don't know what a QSIP is, it's an identifier for any exchange traded product. It will identify alphanumerically whether the product is an ETF, a bond, a stock, all of these things. But when you manage money and your systems are predominantly set up with an identifier as being one of the main, probably the key component of any database, once it has a QSIP, you open Bitcoin ability to be allocated anywhere and any analysis. There's so many legacy platforms that probably, couldn't even accept Bitcoin until it has a QSIP. So well done, Elliot. The Canadian government is subsidizing your purchase of Bitcoin. I'm all for that. And that's why I would hold both. Ultimately, cold storage is the solution, but in terms of tax advantaged accounts, bring it with an ETF and low basis risk, high liquidity, good market makers, creation redemption features. I believe it's all good for the ecosystem. It's just one more on-ramp.
I think you brought up a good point, Greg, with the pricing mechanism. And here's a commonly heard discussion on BlackRock. For those that are in the institutional space that have been working hard to get these people's attention, hey, look at Bitcoin, look at Bitcoin. We see something like a spot ETF as a gateway, a way to kick the door down, a way to bridge institutional money. A lot of the people that are holders in Bitcoin look at it as just a mechanism to manipulate the price of Bitcoin. So that's a great thing that you mentioned about the pricing mechanism. Why is it not in the best interest of an ETF to try to manipulate the price of Bitcoin to their favorite or do, manipulative type things to make profit on a Bitcoin spot ETF?
Can I take that? It's a great question and goes to the fundamentals of an ETF. ETFs are by definition transparent to the dealers that quote them. And actually for our ETFs, they're transparent to the public as well. You can go to our website and see exactly what's inside our ETFs. We post it there. And I believe that in the US, that's substantially the case as well. So I think there is some fear out there that, Wall Street is a black box and people manipulate things. And, you know, I know there's a lot of speculation about, you know, how much gold is really in the world versus in various products. And I think this is a really important point to focus in on. Why is the Spot Bitcoin ETF such a big deal? Why is this BlackRock filing such a big deal? I mean, we've already got BITO, which is a futures-based Bitcoin ETF. What's the difference? And the difference is the difference between synthetic versus physical, really anything. But in terms of Bitcoin, especially Bitcoin, because you want to make sure, you know, as much as it is, and happily true, you know, Greg's right, not your keys, not your coin, but you want to make sure if you're holding an ETF, the ETF is holding coin and has what it says it has. And that's where the transparency component comes in. So every single night, our business sends out to the market makers, these are banks who quote on our funds, the portfolio holdings of every single fund. So that when those folks show up in the morning to start the day, they know exactly what's inside our fund. So they know exactly what price to quote if they're buying or selling units of our fund to the general public. So as it relates to our Bitcoin fund, they see exactly how many Bitcoin are in there. There is nothing we can do to trick them into believing that there's something in there that isn't there, because this information comes straight out of our custodian, CIBC Mellon, a heavily regulated business, and sent through to the banks and brokers that quote on our fund. It is completely transparent. Now, we don't have the ability to move the price around, but nor are we trying to. Our ETF actually is trying to be as passive as possible as it relates to holding Bitcoin. So when a dealer runs out of units of our fund and needs to buy more, they're going to send the fund cash, and the fund needs to go and buy some Bitcoin. The way that we've structured our product, we use the same index price as the futures market uses for the futures. And the reason for that is so that we can go and buy spot Bitcoin at exactly that price every single day, because the people we buy the spot Bitcoin from are the large trading firms that trade spot and futures. And therefore, any risk of price movement within the fund, they're taking and they're putting into the futures market, so they can deliver to us the spot price. This may be a little bit complicated, but it's exactly what futures markets were built for. Way back when farmers wanted to hedge their risk of a crop coming in by selling futures or buying futures on something like grain. And then the people who were buying the grain wanted certainty of knowing what they were going to pay. That's what futures are for. And the same exact principle operates here with our ETF. So this is long-winded, and I mean, you know, as Greg mentioned, like, I love these technical details. This is why I get up in the morning. But the bottom line for investors is very simple. You could have new creations on our Bitcoin ETF of any large size. It really doesn't matter. So that means you could have new people buying lots of it, or you could have existing unit holders selling lots of it. And it makes no difference in fulfilling those purchase and sales of the fund. The fund always programmatically is 100% deployed in Bitcoin all day, every day. So if you buy our fund to day trade and you're only going to hold it for an hour, it's the same as buying that much Bitcoin. You can go buy EBIT right now and hold it for the next hour and a half and sell it at the close. And you'll have the price performance of Bitcoin for that hour and a half as if you went and bought physical Bitcoin. Same is true if you hold it for a week, a month, a year. It doesn't matter, because it's 100% deployed at all times. And by being 100% deployed and by being perfectly transparent, you get the benefit of holding Bitcoin as if you were buying it yourself. And therefore, we're not manipulating anything. The market cannot be manipulated, because all we are is a packaging mechanism to help get more people into Bitcoin. And if I could just jump on one other thing that Greg said around QSIPs. This is the key that unlocks the institutional market. Institutions are required through their policies, through their history of the systems that they've built, to only invest in certain assets, and having something that has the ability for them to hold it at their custodian as if they were holding a stock or a bond is critical to bringing them on board. Now, we've had that here in Canada, but we're not BlackRock. When BlackRock gets the blessing to do that in the US, that's the green light for other institutions to know that they have regulatory clarity to go out and do that. And I think a lot of them will be going out and buying it through the ETF. Some of them will go direct and buy it themselves, much like MicroStrategy has, but I think the ETF is really going to unlock a large amount of demand that's been sitting on the sidelines because of these plumbing features and because it's transparent and because you can know by looking at it, I've got Bitcoin. And that's exactly what's inside the product because it's transparent.
Hey, Elliot, that's great. So a question I have for you on that along the same lines, and I appreciate all that explanation, the back and forth of how you obtain the Bitcoin and reliance on the futures and so forth to obtain that through various brokers. But I guess what I'm interested in right here is, this consistent refrain from the SEC in not approving the ETFs has always been based on the underlying spot market, right? They try to draw this distinction between the futures market and the spot market, and they say, despite the fact that we have confidence in how the futures are traded and there's sufficient surveillance sharing agreements, we have real concerns about the underlying spot market where the majority of the volume is ex-United States and in various exchanges that we don't know if it's there's sufficient surveillance to detect fraud and manipulation. So I'm just curious, as a market participant here in your role and having brought the spot ETF in Canada to market, what do you think of that argument? Do you think that it's a valid distinction there, or is it a distinction without a difference, as myself and many others think, in terms of how the SEC views the market and the spot market separate and apart from the futures market?
Well, I think when you're dealing with regulators, you have to at least respect the constraints that they have based on the legislation that they're trying to operate within. And so, when we built our fund, the only time in my life I've been on the phone with a regulator at midnight on a Friday was launching EBIT. So, this is a big lift, right? You have to get a bunch of people who have been focused on dealing with a certain structure within the financial industry to now look at things perhaps in a new way and see how the new thing fits within the old rules. And so just to preface my comments by saying I am not an expert on US ETF legislation, but I have a lot of friends who are. What I have heard in the past week is that the key to the BlackRock filing is the surveillance agreement they have managed to get put in place between Coinbase and NASDAQ as it relates to their ETF. And so within the rules, there is mention made of the need for there to be surveillance of a venue of significant size where the underlying asset that you're going to hold in your ETF trades. So significant size, Coinbase checks that box, and the surveillance mechanism is through NASDAQ's existing technology that the regulators use to surveil all kinds of other things that trade on NASDAQ all the time. This is something that is new to the BlackRock filing, and it's one of those things that when you look at it, you think, well, why is that in an ETF? We don't really talk about those things in other ETFs. That's a clue that BlackRock knows what they're doing, and it's a clue that they've been talking to the right people because they're putting in place structures that seem a little bit unusual, but are meeting a particular need within the rules. And so what I think we kind of have evidence of as it relates to US Bitcoin ETFs is you've got the SEC on record saying that Bitcoin is a commodity, not a security, which is also supported by the CFTC Bitcoin futures. You've got now an exchange of significant size being Coinbase, providing data on their Bitcoin trading to NASDAQ, who has a surveillance system that allows the regulators to look at the trades of the underlying and then look at the trades of the ETF itself and perform its surveillance function that they're required to do as a regulator. That's a really, really big deal. And that's one of the reasons that we are so confident that BlackRock's going to be successful on this, because you would not put a feature like that into your product unless somebody had told you, here's the checklist of things that you need, go ahead and go and do them. And so, it's similar, in fact, to our filing. We had to do things like remove, possibility for in-kind creations. We had to put in stipulations that we wouldn't rehypothecate our Bitcoin. We have to know our counterparty. There's all these things that are much more buttoned down in our Bitcoin ETF than, they're sort of assumed to be okay when we launch an equity ETF, for example. So those are the things that we expect to see being the reasons why they're going to be successful. And from talking to some other folks, it sounds like the other exchanges that have listings are running fast to try to get that feature built out as well. So
yes.
NASDAQ's not the only one. Cboe has some listings as well that are filed with them. And So that to us was the evidence that and BlackRock being BlackRock, but those two things together give us high degree of confidence that BlackRock has a launch solution.
Yeah, and they actually mentioned this in the appellate court brief in the Grayscale case. They talk about how the market of sufficient size needs to be one where there's a reasonable likelihood that a person attempting to manipulate the ETF would also have to trade on that market to manipulate, so that a surveillance sharing agreement with that market would detect and deter misconduct. So the question is, if someone were trying to manipulate the Bitcoin spot market, would they necessarily or reasonably have to trade on Coinbase?
Well, maybe another way to look at that, by the way, and I think it's relevant because it goes to the quality of these products. The index price that we're using, that BlackRock is also using, really deserves to be examined a little bit. So we use CF Benchmarks. CF Benchmarks is a firm out of the UK. They're owned by Kraken, and they are the reference price and the settlement price for the futures. So they've had probably somewhere $700 or $800 billion worth of Bitcoin futures have settled on CF Benchmarks reference rate since the beginning of 2018. Now, it's not just size and history that matters. These are the most regulated index providers in the crypto space today. They are regulated in the UK, where they're domiciled. They're regulated in Europe, and the futures themselves are regulated by the CFTC. They have a very, very prescriptive set of rules to become a contributing exchange. And I believe there are only 5 exchanges that qualify for their rule set. And that has to do with the exchange having protections against wash trading, surveillance systems, and other things to ensure that the exchange itself is a very legitimate entity where Bitcoin is being traded. Then on top of that, they actually measure the last hour of their trading window in 5-minute increments, and they knock out the top and bottom prices and then take the average of those, and then they average out all the increments across the last hour. So the point being, if you want to manipulate that index, you need to attack the 5 best run Bitcoin exchanges in the world every 5 minutes for a full hour to be able to change the price from what it otherwise was going to be. So best of luck if you think you can do that. I don't think it's possible. Oh, and by the way, you have to do it in a way that's not detected, because by being part of the BMR in Europe, these guys are legally required to report any possible attempts at manipulation. And so all of this is on their website, and you can actually go and see every single day they report, we did not detect any manipulation. And the next day they say the same thing again. It's unbelievably well put together and transparent. That quality of that index will allow BlackRock to do what we do every day, which is to trade over the counter for their Bitcoin at that price and have no slippage. This is critical to being able to deploy a product properly. Some of our competitors, when they launched, they were short settling cash to pre-fund an account to go chase their NAV price on some exchange somewhere. You don't want to do that. And, I think it's sort of ironic that we've been running this Bitcoin ETF since February 2021, and I haven't traded any Bitcoin for it because I don't have to. I just go and make an over-the-counter contract with a counterparty for the price that I want, which is based on this very transparent reference index. And that's what we do. Nobody at Evolve is logging into, an exchange with all kinds of prices, going past them on the screen or anything like that. It doesn't happen that way at all. It's all very, very programmed. And so this is a tribute. And if I could just provide really a shout out to the industry. This industry plumbing, which is super exciting to me and probably boring to everybody else, this is what makes Bitcoin now ready for prime time, okay? And I'm a Bitcoiner, believe me, I have a hardware wallet, I have lots of Bitcoin myself, separate from my fund, but I believe that the future will be a future where we have a combination of the existing industry infrastructure that's available today, along with Bitcoin as now a key asset within that infrastructure that is included in the way in which people can work on their financial plan and save for the future. That requires these two things to come together. In 2017, when we filed for our first futures-based ETF, and we talked to the big investors in the space, so big pension plans and others in Canada, the message we heard was, I can't talk about Bitcoin because there's too much career risk if I talk about Bitcoin. You fast forward to 2021, those same big investors were saying to us, I have to know about Bitcoin. There's too much career risk for me to ignore Bitcoin. And now with BlackRock, we think the conversation next year is going to be, I have to own Bitcoin. There's too much career risk for me not to have it. And people are going to do what Greg has been telling them to do for the past 5 years, which is they're going to get off zero. And I think that transforms everything.
Elliot, follow-up question. Your Spot Bitcoin ETF was approved in early 2021, and we talked about this. Late 2021, the Ontario Teachers Pension Fund makes an investment, a private venture investment into FTX. They lose it all, 95 million. Gone. Quebec, they also made an investment into Celsius, gone. This tool was available to them. It was there. What was the barrier? And how can we overcome that barrier if a ETF like BlackRock gets approved and opens those doors?
So this goes to the heart of the matter, and it has to do with people are really good at doing things that they've done before and really bad at doing new things. And so the lack of regulatory clarity around, like just to pick one thing, which has changed now twice in the past 3 years. The IFRS treatment, that's the accounting treatment of Bitcoin for a corporation, has gone from being fair value, meaning every year when you do your financial statements, you say, how much do I have? What's the price? That's the value. To a long-lived intangible asset, which is what it was treated as last year, which means you can only mark it down when the price drops and you can never mark it back up. And now IFRS is changing back to fair value, okay? So it's a confusing technical accounting point, but the bottom line is the regulators weren't clear on what to do with Bitcoin in 2021. But teachers, along with a lot of other big investors, didn't want to miss out on exposure to Bitcoin and other forms of crypto, okay? So they did what they can do, which is venture investing. These guys are built for having a small slice of their portfolio in high-risk venture investing. And so they bought some stock in FTX. And, we can tell now, obviously they didn't do a particularly good job of due diligence on that investment, but they already had a team. They had an allocation for venture investing. They had a committee that would look at all of their high-risk venture bets. They had all of that stuff in place. It was easy. They said, okay, I got a round peg. We got a round hole. We can go put that in there. That works. Bitcoin is a square peg. The difference is, and I think, again, coming back to the BlackRock filing, we're going to get a square hole now. And that's a big deal because it all comes back to first principles, right? Like if you're trying to convince a group of people to do something, you have to meet them where they are. And people need to feel that they are comfortable bringing this forward. And I'll tell you, when we launched our Bitcoin ETF in 2021, I was actually amazed by how well educated the portfolio teams were at the very big institutions when we talked to them about Bitcoin. They get it. They really do. And probably a lot of them have been, to the big conferences and, they don't wear their name tags because they're kind of, they're institutions. They don't want anybody to know who they are, but I'm sure they've been there, at some of the big events. They were very well educated, but they weren't buying Bitcoin. And it's the same old story, right? Bitcoin is the only time in my career I have seen the opportunity for retail to get the first bite at the apple. Usually it goes the other way. Usually you go with venture and then you go public and then retail gets it after a lot of the value is created. And this is inverted because any of us can individually decide to participate, and it's taking a lot longer for the institutions to get there. So I think that's it. I think, we have to remember these are all well-meaning people doing the best that they can. I think there's a lot of embarrassment over the FTX situation for sure. But when that same investor invests in Bitcoin, it's not going to be through the venture team. They're probably going to put it in, whatever group there looks at investments like gold, for example. It'd be a completely different group.
You talked about how the folks on the pension fund that know, or it's their job to know about Bitcoin, are very well educated, but we got to educate everyone, right? The pension fund has a lot of moving parts, a lot of pieces. And like, it seems like there's a natural tendency to go learn about this, give us a presentation, and then go sit in a corner. We're going to do our work. I don't, not quite sure. But obviously they're going to catch up with that. They have to. I know Rapha has some really amazing calculations and analytics on what it might look like. And I think it's worth talking before we kind of take on what a allocation that we would make, to bounce some scenarios off of you, where let's imagine Ontario Teachers Pension Fund did allocate some funds to Bitcoin, and let's play some scenarios of like things go well, things don't go well, and how does that affect a fund like that having to move pieces. Rapha, if you want to throw some scenarios at us, what that might look like.
Absolutely. Yeah. I think that there are a lot of points here that we discussed that we can go back now to the numbers and see, how it would fit. Just as I share here, what we did is we got their latest investment policy statement. So, this is public information. It can go to the website. And it's actually, the new one is probably going to be coming up in the next few weeks. But you can see what they're allocating to, what their investment policy is. And if you go, this is actually very interesting as I was looking to this. First of all, a couple of things I've noticed, right? So if you go to their asset allocation, this is their target asset allocation, what they're looking to do and where they should be ultimately, right? First of all, you notice that the numbers don't add to 100%, they add to 110%, which means that they can apply leverage, right? They can put up to 10% leverage to their portfolio. It's not that much, not necessarily bad. But I'll come back to this and why it's important. Just to the TLDR is that it's very hard to get to what their ultimate return is. So they need to get some leverage to get the 575 or a CDI plus whatever it is that they need to get, right? Another thing that it's interesting is that they actually have a bucket here where Bitcoin would fit, right? They have real assets, right? They have 37% of their portfolio that it's actually that goes to real assets. And I would argue that there's no other asset that is more real than Bitcoin. It should fall right here. But not surprisingly, when they talk about real assets, they're talking about real estate and infrastructure and renewable resources. There's a large piece of that there. And again, I'm not going to get into the merit of if this is good or bad, but there is 15% of their portfolio that is targeted to renewable resources. The other thing here that we saw is that if we look into their fixed income portfolio in credit, right, they also buy leverage loans. So there's more embedded leverage in what they do. At the end of the day, if you look at the overall risk profile of this portfolio, I would say it's fairly aggressive, right? But don't take my word for it. So what we did is I got each of these asset classes. I found benchmarks. They actually detail a lot of the benchmarks that they use already here on the right. So I use their benchmarks. I went to Nakamoto Portfolio. And one of the things, again, going back to what Elliot said, that we're trying to do more and more is to close the gap between what the asset managers, the portfolio managers, the family offices, how they talk about their asset allocation and how Bitcoin should be in their asset allocation, right? So when we go into here, what I did, and one of the things we're going to be doing, Dom, is after these calls, I'm going to be saving these portfolios so that, when we come back to the next program, we can actually see how they're performing. And if they had Bitcoin, how would we have performed? See it changes that they made to their asset allocation and so on. So if you go to Nakamoto Portfolio, and then, you could do two things. You can either include the portfolio here, which is what I did. But more importantly, I already included a portfolio here. There are two portfolios that I included here. These are going to be available for everybody. So here's here. Sorry. I'm going to be putting these two tabs there. One is their target asset allocation, the one we just discussed. And I went one level deeper to show where their equity allocation is. So there is another thing that surprised me when I looked at the returns. If you look at their top 10 holdings, they're 63% of their equity allocation. It's highly concentrated also, not necessarily bad. I mean, if they are good stock pickers, they are going to have very good performance, but there's a lot of room for error there and a lot of room for things to go bad. Like, one example is one of the allocations that they increased the most in the last quarter was Netflix. I don't know if it's a good investment or not. I just don't think that in a pension plan, you should have a very outsized allocation to a single name, right?
Not after they got that where you can't share it anymore and use your family's password. Game changer.
Can I add though? Can I add? Now this is brilliant. Okay. And I want to keep this brief. Ontario Teachers has come such a long way, because when I started my career trading bonds, Ontario Teachers was restricted to owning one asset in their entire portfolio, Rapha. Did you know that? They had to own Province of Ontario bonds. That's it. 100% exposed to Province of Ontario bonds. And along came Bankers Trust, who said, you guys got to diversify your returns. I have this thing called a total return swap on equities, on the S&P. And the amount of volume that Ontario Teachers did to swap out the cash flows on the provincial bonds into other asset classes to diversify the portfolio was beautiful. Now, Bankers Trust probably made so much money off those trades that half of the Hamptons is constructed because of Ontario Teachers swap flows, but it doesn't matter. This is a portfolio that went from being 100% allocated to provincial bonds into this. And we can say what we want, but this is a measure of forward thinkers. And I applaud them for that. Yeah, they invested in FTX, but it came in a different silo, as Elliot said. And they would have been better off served in Bitcoin. We know that. So go ahead and keep that. But as a positive, they were forward thinkers 35 years ago.
And just tacking on that real quick before Rapha gets back, they are funded at a rate of over 100%, which is a testament to them. I know they're a newer pension fund that started in 1990, but there are a lot of aggressive forward-looking things. And I think of many funds, they get it, that they have to be forward-looking and aggressive to keep up with a growing liability that is going to keep growing through all kinds of factors like longer living retirees, potentially people dropping out of becoming teachers and inputting into that fund. There's a lot of different things that can affect that. So they are doing a good job for sure.
Yeah, and I actually liked when we picked them exactly because of that, because among the pension funds that we could have picked, right, they are the ones that I think are better positioned and have the probably one of the best asset allocations out there. And even them, when we run the numbers, right, we see that the Bitcoin allocation has a place and should be there. So that, of course, would make sense for a broader population. Just to recap, one of the things that, their job is very, very hard. Like their target 30-year return, which is stated by the investment policy, is to either get inflation plus 3.25% or a nominal rate of 5.75, whichever is higher, right? This doesn't seem by much, but it's really, really hard on the long term, to be consistent and to actually beat those numbers. And this is exactly why they need to diversify. They need to have exposure to other asset classes, right? And I think they've done a decent job with that. But the same way that diversified into private equity, venture capital, and other things, real estate, other things, they should also definitely have some Bitcoin allocation, right? Let's take a look at the numbers, right? Let's see. Here is the conclusion of the numbers. And again, I'm not going to go too much details here, but there are a couple of things I wanted to highlight. The first is I got all of those benchmarks that they mentioned. These are the blue parts here of the table, right? And I included them. And this is all, of course, backward testing, but I looked at what how they have performed. And what you see here in the green line is their portfolio. The annualized return of their current target portfolio doesn't get even to what they need in their benchmark. It's 4.27% before leverage. And again, I'm pretty sure they ran these numbers as well. And that's the reason why they need leverage, is to get closer to what their benchmark, their target return would be at the end of the day. And then what we did, again, is we included Bitcoin here to see what would have happened. And what you can see is that return of 427, if we include a small allocation, right, just a 2% allocation to Bitcoin, that return goes from 427 to 6.11%. It already beats their benchmark just by putting a 2% Bitcoin allocation. And again, assuming that future returns are going to be similar to past returns, which is a big if. I would argue actually they could be better, but that's a complete separate discussion and conversation. In terms of risk, right? Because that's the one question that everybody asks, like, well, I'm going to include Bitcoin, it's going to increase the risk of my portfolio. And it does increase a little bit. So if you measure risk by volatility, the volatility goes from 1128 to 1141. So it goes up a little bit. But when you look at your return adjusted by volatility, right, which is what really matters, is how much volatility you're getting for additional measures of return, you go from 0.27 to 0.43 in your Sharpe ratio. So yeah, this is a significant difference in Sharpe ratio. And then the other number I thought was very interesting here. If you actually look at the right here on the right-hand side, almost at the end of the columns, you have the 1 year, the 2 year, and 3 year returns. And you see that in 2 years, this current benchmark actually had negative performance. It's down almost 10% in the 2 year performance. If you actually added Bitcoin, you would have reduced, even though it was a very, very bad couple of years for Bitcoin, right? Bitcoin was also down. It wasn't down as much as their benchmark. So it makes a lot of sense. Another way to look at this is we always look at drawdown charts. What this means is that we're looking at the biggest drops that you have in your portfolio. And here I have two lines. I have the portfolio and then a portfolio for 2% Bitcoin allocation. And you can see that these lines, they're very, very similar, which means that, on average, you're not increasing your drawdown that much. And then just to find out, another thing I wanted to mention very quickly is this is a correlation table between all of their assets and, of course, Bitcoin. Having light shades here means that Bitcoin is uncorrelated to pretty much any asset that they have in their portfolio. And on a portfolio modeling basis, what you want to see is an asset that has positive returns, of course, low volatility if it can get you, but more importantly, low correlation to your overall portfolio. Why? Because whenever your portfolio is going down, you don't want that asset to go down as well. And when your portfolio is going up, it's okay if that asset doesn't perform that well because the rest of your portfolio is performing well. And there's pretty much no correlation between Bitcoin and any of the assets that they have in the portfolio. Another thing we like to see to show is this chart. And again, it's going to be hard to read here, but I think Bitcoin scares a lot of people exactly for this and for the wrong reasons. And I'm going to share this later so it's easier to read. But what it shows is that these are the annual returns of each of the assets that they have in the portfolio plus Bitcoin. And what you see is that Bitcoin was, of course, the larger performance 2015, 2016, 2017. The worst performance 2018, and then again, the best performance 2019, 20, and 21. And again, the worst performance 2022. And unfortunately, people, going back to what Elliot mentioned about career risk, the manager that picked Bitcoin in 2021 and went through this, he has a lot of explaining to do, right? Unfortunately, because he's going to have to say, I was the guy that picked Bitcoin and Bitcoin is down 65%. Curiously enough, if he is the manager that picked FTX, he's okay because that's part of private equity investments. You are going to have a failure, every 10, 20 different assets that you invest. If he had Bitcoin, it would be a very different conversation. And then just to finalize, Dom, and then we'll go back, we actually ran optimization. So I included Bitcoin in the portfolio. And then the question here is, let's say I want to do two things. The first one, I want to find the optimal risk return for this portfolio. So that Sharpe ratio that I was saying, what is the optimal one that I can get? And then give me the allocations that I would need in each of these assets to get there. And the optimal risk return portfolio has, of course, a lot of the assets that they picked, but it would have 25% Bitcoin in this portfolio. Why? Because, again, low correlation to the overall portfolio, positive returns, so it makes sense. I'm not saying they should have 25% allocation to Bitcoin, but again, if they're trying to optimize for risk-adjusted returns, this is where they should be. Even if you look into risk-adjusted on equal portfolio basis, right? So each asset would contribute equal risk basis. Each asset would contribute to risk equally. Bitcoin is still here at the 2% allocation, which is what I suggested here. I think that a 2% allocation, Bitcoin would have the same contribution to risk to their overall portfolio. So again, it makes a lot of sense to be in this portfolio. So I'll stop here. These are the numbers that we ran. As I said, we're going to include all of these on this tab here. And what we have also is that we have here the comparison of all the portfolios that we're tracking. And they're going to be here in the bottom. I'm actually going to include, a date, an inception date of when we started tracking this, and we're going to be able to see and come back to this, in 6 months' time, in a year time, and see, hopefully by then, because of the ETF and whatever it is, they would have added Bitcoin to their portfolio. But if not, we can take a look and see how a Bitcoin allocation would actually have helped their overall asset allocation.
What a unreal tool and breakdown there, Rapha. You're a wizard. A tactician. I would only be so grateful if my pension fund could get a breakdown like this. You mentioned some of the up years and the down years, and talking to Elliot and Greg and Joe, you guys imagine yourselves the CEO of the fund. How do you weather the storm? We know for the everyday people that when you zoom out, you see an upward trend of a very promising asset and a network with so many incredible things going on. But when you zoom in, you have these tremendous up and down years. You mentioned that an FTX loss is part of the business. Venture capital, you get some stuff that goes to zero. If you're sitting as a hedge fund manager or if you're sitting as a pension fund manager, how do you weather the onslaught from the media and the participants of your fund when they are writing in saying, what have you done? Knowing that you haven't sold anything, and how does an ETF weave in to provide some insulation to help them weather this storm? If you guys can touch on that real quick.
I'm happy to take a run at that. Rapha, your tool and the analysis you've done is just amazing. And what you've done with your website for a Nakamoto portfolio is something I share a lot with friends and colleagues. I think it's an invaluable tool for putting the investment in context along with other assets, which I think is important because it isn't only Bitcoin or other things. It's how do you add it and include it. I think, Dom, to your question, part of what you need to start with is what's the frame of mind of the people who are running the pension? When your draw rate is inflation plus 325, you may be looking at a lot of years where you're not going to get above your hurdle, even though the inflation numbers that you're relying on from the government are understating the truth about inflation. So you still have, now you're going into a period of time where you are looking at the possibility of underachieving your hurdle, possibly for a very long time. So folks who are in that position as institutional investors are looking to do things to try to resolve that. So one is you're going to see increasing demand in the private space, private equity and private debt. Institutional investors love those things, partly because you don't have to mark them as frequently, so you can maybe smooth out some of the drawdowns that happen. But they don't defy gravity; they're just private, and so. But they should have at least the illiquidity premium that you don't get to capture in the public markets. As it relates to including Bitcoin, I think, Rapha, you nailed it. The challenge on the chart where you showed the explaining you have to do in the down year, the challenge is the volatility. And it's, I think, the single biggest thing preventing broader adoption of Bitcoin in investor portfolios is dealing with that. Now, obviously, you can deal with it. It's just called position sizing. You make sure that you don't have so much exposure that when you have that 80% drawdown every 4 years, that you're on the wrong side of the trade, or you're levered long at the wrong time. It's actually mathematically not that difficult to figure out what to do. But I think a lot of investors, institutions in particular, would rather deal with the mechanical challenge of a high volatility asset when you need to be longer vol in general, than deal with the melting ice cube they have, which is really the grind down of their overall capital base from inflation. And you're not going to find a solution to inflation by using the techniques that worked in the past 40 years. That's not going to work, because in the past 40 years, we had the entire credit and debt system going in one direction, and now it's going to go in the other direction one way or the other, depending on how it gets recognized. And I'm not saying anything here that's unique or insightful. If anything, I'm doing a bad job of saying what Greg says all the time. But the bottom line is, it's really tough to figure out where to hide right now, given the big macro forces of central banks and interest rate policy. But Bitcoin has these unique features where it's both digital gold, and the value of it is also going to be a function of Metcalfe's law. It's going to be a function of the adoption, the size of the network getting bigger all the time. Those two things I've never seen before, because you have a hard asset that has the growth dynamics of a network effect, and at least for the next kind of 5 to 10 years, that network effect input into the price is going to be pretty meaningful. That's why we're all interested in when did the institutions get here. And so right now, I think it really is down to whether or not the big institutions can find their way to figuring out where Bitcoin belongs on their balance sheet, and figuring out how to manage it going forward, recognizing there's price volatility in the short term. My personal opinion, the price volatility gets less and less every cycle because as adoption expands, there's just going to be less of this early stage volatility that you typically see in venture businesses, and you're going to have a more stable price point. But I would encourage everybody who looks at the volatility to recognize that there are two sides to the price, and one side is the fiat currency you're pricing it in, and if you're not looking at the flaws in that, you can't really examine whether or not it's stable. So those are just some thoughts I have on the subject.
Yeah, Joe, jump in. If you're in that spot.
It's a great discussion, and I have it with clients all the time trying to get into this market. So I think I agree with everything Elliot said. What I'll just add, just sort of my own particular spin on it, as a litigator, a big part of my job is assessing risk. And one of the keys to assessing risk, particularly when you have to answer to somebody and explain to them, hey, how'd you go to trial with this and get hit with a big judgment? It was a bad move. You have to set expectations. You have to go in with the data that Alpha Zeta has there. And, what I tell people when they're buying Bitcoin is be prepared for significant drawdowns. Be prepared for drawdowns beyond anything you could imagine, really, and realize that this is a long-term, multi-decade bet. But the key part that Elliot alluded to is this issue of market maturation. Right. And I think if you go back and look at some of the historical data about the stock market in the early 20th century, even before then, was a much more volatile environment than we had right now. We didn't have the market depth and liquidity. We had lack of regulations. And what you see with the maturing market is what Elliot alluded to, this general trend of reduction of volatility. So, as Bill Miller said, the great investor, that, volatility is the price you pay for outsized returns. That is the key, right? So you have to go in with the right mindset, with the right expectations. You have to go in almost where you're going to say, I'm going to come back to you 1 year and you're going to see a 50% drawdown in our Bitcoin position. Just be aware of that. It's going to happen. But you're also going to see these years where you get 200% or 150 or and so forth. So that's really key. Setting expectations, good setting expectations, like any good marriage, right? That's the key to happiness. You got to let people understand what you can assume to see from the Bitcoin price movement.
Yeah, you brought up go ahead, Rapha.
Just to add one thing, I think that, I love volatility. As Joe said, the fact that we have volatility just proves that we are very, very early on these assets, right? And don't go too far. Just compare the market cap of Bitcoin at 580 something billion, right? And compare to other assets like real estate, 320 trillion, and which a lot of it's monetized because people are trying to protect against a debasing of their assets and stocks and bonds and all of that. We haven't even scratched the surface, and because of that, as you are very, very early, any small changes in the perception of Bitcoin being able to capture even a small amount of any of those assets is going to make, or the opposite, right? That Bitcoin is going to fail and it's going to go to zero, which some people still believe, right? Even though that's not going to happen. The changes between these perceptions lead to volatility, which again, just shows that we're really, really early on this, which is great. There's a huge amount of upside, and the downside, we know what it is, right?
And there within lies an opportunity, right, to open the door in educating institutions on the volatility and also educating them on the value of the network, the community, decentralization. A lot of people think institutions mean they're going to kill this beautiful thing and try to, make it centralized and do that. That may happen. But in the education on volatility, you can start educating people and institutions on the other value side, other than just this asset, which, as Greg says, and we know, it is going up. It has gone up. It will continue to go up. And there's value there. You just have to buckle up and take some wild rides, because there's a bigger picture here than just an asset reporting quarterly earnings and all these little data points. It's a much bigger picture. So,
and the beautiful thing about this is that they don't need a huge asset allocation. It just shows by the numbers that a 2% asset allocation actually would have gotten them to what their target return is, right? 2% allocation. If they lose, Bitcoin goes to zero, they lost 2% of their portfolio. Bad, it's not existential, right? But if Bitcoin becomes a main asset, as we all believe, it has a potential to, not having a 2% allocation is also going to have catastrophic risk, because everything else that you have is getting eaten by inflation and by debasement, right?
Absolutely. So much still we could jump into, Elliot. And before we let you go for our like big board meeting of us four degens, and we kind of make an allocation, words of wisdom to us. You know, I can anticipating Greg wanting to put 100% of the teachers fund into Bitcoin. No, he wouldn't do that. But you know, if you're giving us advice going into this, making a selection, maybe some things that you'd pull from some areas. Again, this is not financial advice, but this is just like some pearls, knowing what you know and how you might kind of advise us to make a selection.
Well, like it's flattering to think that I could have words of wisdom for the four of you, but I would say this, that a big institution is going to be looking to diversify across a variety of different return streams, and that's really where they may need to carve out a new space within their strategic asset allocation for this particular return stream. This isn't just like a new equity that went IPO yesterday and they could just throw it into an existing bucket, but one way or the other, it's required. So I would just say, you know, you do want to size for the volatility. You do want to make sure that you've got exposure to Bitcoin, and you do want to make sure that you've got enough other things so that you can meet your cash needs on a year where your Bitcoin position is down and you're not in a position to sell it to raise cash. It's like running any other kind of portfolio. And I think that's really, the more the world gets to that frame of mind, and the more normalized adding Bitcoin becomes, then the more you're just going to see people utilizing it as a portfolio construction tool. And that's really why we built our ETF in the first place. We wanted to take it from, take Bitcoin. We heard all these stories of people who said, you know, I've opened an account at a crypto exchange, but I won't tell my advisor because I'm embarrassed about it or whatever. And the advisor says, I would like to be able to advise on how that asset fits into the rest of the investment plan that we put in place for you. There's really no reason for those kinds of things to be in conflict with each other. And that's really what we tried to do by building the ETF. And I think it's working. So, so anyway, those would be my final comments. And it's really been great chatting with all of you.
Don't go yet, Elliot. I want to just sing your praises and thank you for coming on behalf of my American friends. Great job. Rapha, your model is off the charts brilliant. I just can't say enough about it. Joe, you stole my thunder when you told us that Bill Miller, volatility is the price of return. Brilliant investor. No, Dom, I wouldn't be 100% invested in Bitcoin because I am not 100% certain it is going higher. I believe it is, but I cannot possibly be 100% certain about it. What I am 100% certain of, and this is what you have to bank on, fiat is programmed to debase. That is the certainty. That is the math. That is the mathematics of a debt spiral where they have to print money to meet the interest expense obligations. So I've never seen a simpler investment decision in my life, which is to move some of the exposure from government bonds, which is a soft asset, into the hardest asset that man has ever created. It's called Bitcoin, and you don't need to have 100% of your portfolio in it. But if you did, you'd only have to employ one person. And maybe there is the efficiencies that come with that. I am not advocating 100% position, though, for Ontario teachers, but get off of zero, please, on behalf of all of the hardworking Canadian teachers that perhaps don't know how to manage risk themselves. So, Elliot, thank you so much, brother. You are, I can't wait to share offline how proud I am to be part of this journey that Canada is, that you've helped Canada on. Thanks for coming, my friend.
Yeah, for sure. And Elliot, let us know, where can we find you for listeners on Twitter? And I know Evolve has a Twitter. If you have that, we'll post that up here for sure.
Yeah, so I'm on Twitter at Elliot Evolve ETF. EvolveETFs.com is the best way to find out about our products and connect with any of us. So I encourage you to check out our website. Listen, thanks very much, Joe, Rapha, Dom, and Greg. Really great chatting with you. Appreciate you inviting me today.
Thanks, Elliot. Very good, man.
Thank you, Elliot. we'll talk to you soon, I'm sure. So we're going to get in this hot seat right now, and we're going to make an allocation. We'll let you know how it goes if we're still, alive when we get out of here. Okay, so now is the portion where we are in the hot seat. Again, it's easy to throw numbers around and make some picks, but keeping in mind there's 330,000 people and more depending on this fund. These are teachers, these are working families, these are people that have traded a lifetime, a career in order to live out years comfortably, take some trips to the lake. So there is a lot of pressure here, and I think we always, when we're doing modeling and stuff like that, it's easy to forget. But let's put ourselves in that seat and talk some ideas and just fire off on like what we think would be a good allocation, and even maybe where it might come from and how it might be set up.
Dom, just before we start, just to give us some numbers to kind of base and have some reference, right? So right now, as Greg mentioned, government bonds, 25% of their target return, right? Real estate, 22% of their target return. So these are the largest asset classes within their portfolio, their target returns, right? Inside of there are a couple of things that I would highlight also. Equities, you go into their equity allocation, 7% of their equity allocation is Microsoft, single name, right? JP Morgan is close to 5% of their equity allocation. Amazon is also another close to 4%. So these are all single names where they are taking risks that I would argue are higher than what you would take in something like Bitcoin. The other thing, currencies, right? You look at their exposure, because some people will think of Bitcoin as a currency, although I don't agree, something to think about as well. You look at their currency allocations. Of course, vast majority is US dollar. They have 67% in US dollar. But the remainder is across different countries, right? So, and this, of course, taking out the Canadian dollar, right? So, Brazilian real, they have 3% of their allocation in Brazilian real. I would have I will tell you, as a Brazilian, the right allocation there is 0. Shouldn't be any more than that. And they have 3% allocation to Brazilian real. So,
what's their allocation to cash or cash equivalents? All fiat. What is that?
So very little, like short-term bonds, right? It's a 2% of their target asset allocation with a maximum of 8%. If you look at their latest report, it's very, very close to 0. They don't have pretty much anything in cash or cash equivalents. If everything gets allocated to longer term. Yeah.
Greg, maybe one thing you can tie in on, with your experience, what is some of the easier places to move funds from if you were to go directly from a portfolio of something like a pension, as far as not taking a net loss? I mean, you could say, let's sell our commercial real estate right now and go into Bitcoin. That's going to suck. What are some areas you could move money and make some allocations that would be least impactful?
Well, I think probably what you're asking there, Dom, is which one has the lowest liquidity risk or liquidity priced into it. And, coming from the bond markets, I do appreciate the liquidity that's provided in global global bond markets, and the US bond market in particular. I mean, that allocation up there at 27%, that's high. I will note that it was probably higher, and on a mark-to-market basis, since most global bonds have been shredded in the last 2 years, it's come down, or they did a proper duration exposure. That being said, I wrote a paper on this. It's what sort of got me some Twitter fame, is why every fixed income portfolio, every single fixed income portfolio in the world, in my opinion, needs some allocation to Bitcoin, which means my first and favorite spot of taking an allocation from is from the bond portion. Now, I may argue that Microsoft at 7% of the portfolio, damn, those are some pretty big gonads these guys have, that they're rolling the ball on Bill Gates. Well, not Bill Gates anymore, but you know what I'm saying. There's mixing and matching that can go on. So I would take it out of the bond market, but I'm not fussy. I just need to get it into Bitcoin somehow. And then, more importantly than perhaps the allocation, is your rebalancing assumptions and how you're going to monitor that position and manage the risk according to the price swings. And that can be the difference between positive returns and negative returns if you're effectively dollar cost averaging in both directions. So, there's big decisions to be made here. Once again, we have a tool that you can get to the brass tacks on, which is the Nakamoto Portfolio tool that Rapha has put together. I'll just say this. I already know what my answer is, and it's crazy, but it is far higher than the 2%, but it's not the 25% allocation that is the optimal, okay? We're not arguing with anything here. The optimal portfolio allocation, according to Rapha's math with respect to the asset allocations that the teachers have made, is a 25% allocation to Bitcoin. Oh my God. Because at the end of the day, this fund, if I'm not mistaken, what's the size of the fund? Rapha, at least 400 billion US dollars, yeah?
250 billion, I think, right around there.
It's only okay. I'm disappointed. Come on, teachers, get your contributions higher. But anyway, as pension funds go in Canada, that's still huge. The largest fund in Canada, if I'm not mistaken, is somewhere around 600 to 800 billion. But that being said, imagine if you're still 250 billion, and all of a sudden you're putting 25% of your portfolio in that. That's $50 billion of buying into one fund, into a $500 billion asset class. You couldn't do it. It would be impossible. So you have to consider the liquidity constraints in the market as well. So I know my number. Wait until close. I'll wait until the next boys give their things. It's more than zero, and it's not as high as 25%. But come out of your bond portfolio, please.
Joe, talk to us. Kick us off with something that we can chew on what a good allocation might be if you were managing this pension fund.
Yeah, so I'm a big believer in trying to make amends for past wrongs, right? And if I were there and I was just talking to folks and you were trying to have, one, an allocation that you can justify if anything blows up, and number two, you can tie it back to the mistake you made and acknowledging the mistake you made, I'd stick with the allocation they made to FTX. I know it may seem small, but in for a penny, out for a pound, right? That, like the saying goes, you get that initial allocation, you develop some good support. Hopefully we get a bull run and Bitcoin gets to six figures, like I know a lot of people expect in the next couple of years. That $95 million allocation that you put at FTX, that's what, the 3,100 Bitcoin approximately. You have that 3,100 Bitcoin quadruple in value. You're sitting at 400, 500, million dollars approximately at the end of the next bull run. So to me, that would be a huge win for them. It would give them a huge psychological benefit. And my guess is that they would get a lot closer to an allocation like Greg's is probably into the next cycle after that. So, again, baby steps. Baby steps are key. Getting off zero. I'm not going to go. I don't tell anybody go in and put, huge amounts of your money in Bitcoin. That's what I do personally, as I've said publicly many times. The vast majority of my money is in Bitcoin and cold storage. But, I don't have to get everybody else there. And I didn't start like that either, right? I had small amounts relative to all my other assets that I hold. So that's my philosophy on it. Let's go in just for a little bit, and they'll be soon understanding what this asset represents and what it promises.
I love that. Learn as you go. There's also some good sentimental value there to like, hey, we lost everything in this, but let's do it the right way with the same kind of step. Rapha, all right, we got Joe's. Give us yours. I'll tie mine in, which is very simple, and then we'll let the big dog come in over the top with the sledge, and then we'll see where we land. What are you thinking, Rapha?
Yeah, I would actually make a proposal that they include in their investment policy statement, just like they have for other assets, a range, right? So they have, for a lot of assets, a minimum amount that they should have, the maximum amount that they should have, and what the current amount is. And when they meet every quarter, they change these and they determine where they're going to be. Are they going to be closer to the top or to the bottom? Zero is absolutely the wrong answer, right? They're not diversified in terms of fiat. They have 100% in one single kind of fiat. They don't have exposure to the digital fiat, which is the next one that we're going to
zero Ethereum is a good allocation.
It's a
Make
good
sure
one.
That's in there.
Exactly.
Their guide as well. That
so
should be there.
I would say that they should have a 1% minimum allocation to Bitcoin and then a maximum allocation to get started, right? I don't think it's the right number, but to get started at 3%. I think what Joe mentioned is absolutely right, that you have to take baby steps. It's like all of us, right? When we bought our first Bitcoin, we bought a little bit, and then that led us to start discovering and learning and understanding how it really worked. Why do I want to have the real thing? I don't want to have paper Bitcoin. What does it really mean? And you start learning, and so I would start with 1%. I would have an asset allocation between 1 and 3, and that would give them, I think, some time to leg in as well. And then I think they should also include the plan on how to get in. That's huge part of the discussion that we usually have to clients, is that just understanding what the target is the first thing, then how you're going to get there, and an implementation plan of where you're going to be taking that out to, how frequently you're going to be allocating to Bitcoin. I think that's also important. Of course, my instinct is just allocate the 3% and that's it, and right away. But there's also a psychological factor here to guide them through and try to get better. Market drops a little bit, buy a little bit more, right? So I would separate a quarter where they go from 0 to 1%, and then the next quarter go to 2%, which would be their minimum. The next quarter go to 2%. And then hopefully by 1 year from now, they're going to be at the 3% start, which is their maximum target asset allocation.
I'll jump in ahead of you, Foss. As a worker, I'd like to retire sooner, so mine is probably more of a little bit of a degenerate play, but not too crazy. If I were on the fund, I would really consider moving 5% from venture capital. I see venture capital as being a tough road ahead, especially for something like a pension fund, to kind of weather those out, take the losses, pick the right ones, and being on the forefront of venture capital instead of being behind venture capital for table scraps. So I'd look at 5% of venture capital combined with some kind of dollar cost average.
Just one comment here. Yeah. I don't think they don't distinguish between what's private equity and what's venture capital. So it could be that the 13% is just 100, all of it, it's private equity. I think your point is still valid, right? It's just a little bit less risky than venture capital, or less risky than venture capital, I should say.
That's why I keep you guys around here. So, right, that's why you guys are managing funds, and I'm digging the holes with the shovel, or putting out the fire. All right, in that case, I might go 3% off of government bonds, 1% off of Microsoft and JP Morgan for a 5%. I still like this 5% into Bitcoin. I think they can weather that storm and still do very well. They're in a good spot to take a big dive. And I still like the dollar cost average into some form. I don't know if they get a dividend or new money coming in from new hires to kind of do something slower like that. Really set the table, come in and take care of these teachers who are going to have a lot of challenges ahead, and like really take a big bite and get in on this.
Man, that's a good point you brought in. I forgot to mention is they have 25% in government bonds, right? That's yielding yields that they probably haven't got in a while. Don't divest out of anything. Just get the dividends as you're receiving from the corporate bonds and the government bonds, and use that to make the allocation. So you don't need to sell any of other assets. You just get the dividend and invest into Bitcoin as time goes by.
I think that's a great point, Rapha. So here's my number, guys. It's not crazy, but it's probably a little higher. So it's a target, and how we get to that target of 7%. Is very simply, I think if like we have done, the research we've done and the comfort we have in that asset class, it could match a Microsoft type of exposure, but you don't get there all at once. So that's my target over time, but I would start right around where Rapha is saying, 3.5%. So 3.5%, it's substantial. There will be times when you have to decide how your rebalancing is going. And you can determine, to get to the 7%, are you going to accelerate in a down market your purchases and dollar cost average in a down market, versus if you get in and it starts to accrete to 7% just because of portfolio performance or the performance of Bitcoin. All of these are what leads to active risk management. And I'm a big fan of this, having these tools in your back pocket. It's not an easy business managing money. In fact, it's very, very difficult. Having lived those days, Rapha, And Joe, you're a professional investor, mostly for yourself, but I do know you give allocate or investment advice. It's a horrible business.
I don't give investment advice, so.
Oh, you don't? Okay, well, maybe to some of your private clients or whatever, just give investment, whatever you want
nudges,
to call it.
Nudges, never advice.
I
A
give
nudge.
my thoughts.
Education.
Remember this, people. When you're managing money for other people, the easiest money to lose is your own. The second easiest money to lose is a bank's proprietary capital. And the worst money to lose is friends, families, teachers, endowments, things that really matter. And it's not easy. So this is something that will take time. I am convinced with tools like Rapha has put together, it makes the journey that much easier, because it is a journey. It's not a destination. It's a journey. So thank you so much, guys. This has been outstanding. I hope you appreciate what Elliot brought to the table. I certainly learned a bunch today. And that's why I can say without a doubt that Swan Bitcoin and the efforts of Rapha to build this Nakamoto portfolio sensitivity analysis, Joe, the experience you bring to the table from a legal perspective, this knocked it out of the park, guys. I can't tell you. I think this could be the best podcast I've ever been on. Now, maybe I'm biased because of the, I'm very into the decision making here with real portfolio performance and real tools. But I can't say thank you enough to include me in this conversation. This will change people's lives for the better. We need to make this happen. Thanks,
Greg.
Yeah.
You're an inspiration to all of us, man. We look at you. I read your paper a few times. I know a lot of fixed income traders did as well, and people get really inspired by what you do as well. So, it's mutual.
You guys are incredible. I'm honored to be amongst you guys. Let's go with Rapha's selection for this one. Although I think there's probably a way that we can do the individual selections and track it with not too much, because I'm really curious to see how everyone's does, and we can post them with the show. And we'll do more. And this is a great way. Again, what a gift to Ontario teachers' pension to have this and be able to view it. I want to say one thing to the listener. If you, the listener, are depending on a retirement or a pension fund, let's get your fund on the show. Let's explore how Bitcoin can protect your future and the futures of workers everywhere. That's what we care about. That's how we started the show. We want to see people do well and benefit off this incredible thing that we have come to learn about, which is Bitcoin. So thank you guys for being on, and we'll keep rolling, and we'll get another fund on the Nakamoto Portfolio Gauntlet.